welcome to the Business Standard Morning Show. I'm Nazia Iqbal, and here's a look at the stories for the day. Rajesh Gopinathan's decision to step down as MD and CEO of Tata Consultancy Services or TCS has surprised analysts. However, they are not too worried regarding continuity of operations of the firm. So, with the board naming another company veteran, K. Krithivasan, as his successor, what does Gopinathan's exit mean for TCS? Debargya Sanyal brings you the answer.
It's an odd day today, but I'm very happy to announce that after 22 years in TCS, I'm stepping down and handing over charge to Krithi. It has been a fantastic journey for me, 22 years with TCS, 27 years with the group.
In its 55-year history, TCS has had only 4 chief executives. The company's last managing director and CEO, Rajesh Gopinathan, made a surprise announcement on Thursday, stepping down to pursue other interests. The IT Giant's board of directors has nominated K. Krithivasan as the CEO designate with effect from March 16. Krithivasan will be the 5th CEO of TCS. Gopinathan will continue with the company till September 15, 2023, to provide transition and support to his successor. In his 6 years as CEO, TCS added over $10 billion in incremental revenues and over $70 billion increase in market capitalization. He has also been criticized for slowing down the revenue and profit of TCS. What are the challenges then that Gopinath leaves for his successor?
Last 3-4 years, the growth of IT services in dollar term was in a poor 4-5% year-on-year growth. And secondly, post-COVID, the employee attrition became a big issue. So therefore, the not so impressive performance of TCS certainly is in line with the whole industry problem. Managing employee attrition and meeting their aspirations in terms of salary hike, that is one challenge. Second challenge, again, as I mentioned just now, despite the rupee falling very badly in the last 3-4 years, particularly in the last 1 year, the IT industry is not getting the benefit of impressive margin improvement. So, improving the margin would remain as the second challenge.
Chokalingam of Economics Research believes transition will not affect business continuity of TCS. Gopinathan's successor, Krithivasan, hails from TCS Chennai Center, which is one of the biggest in terms of talent for the company. He has been responsible for planning and executing TCS growth strategies. His contribution also ranges from building deep customer relationships to market positioning and improving financial performance.
It will not impact continuity because Tata is an institution. It would repeat what happened to Infosys. It won't affect much at all. And now, apart from being an institution, it also got Tata name in it. So it would be able to attract the talent and maintain the continuity.
He has played a key role in helping customers in banking, financial services and insurance with digital transformation, change management cycle acceleration, value delivery, technology strategy and governance, the company has pointed out in a statement. However, with the fear of recession in US and European markets and BFSI counting for nearly 38% of TCS, will this be a worrying factor?
Everybody on the street was bearish on the IT sector before the third quarter numbers. Post the third quarter numbers, everybody's become positive, especially in times where you have spam and phishing and web frauds taking place. One needs to keep their IT environment safe so that people using the IT environment don't feel cheated in case if something has to go wrong. And for that to happen, you have to take services, platforms, products which is offered or given by IT companies. So I don't think that this will create a long-term negative. Short-term, medium-term, there can be certain hurdles, speed breakers, no doubt about that.
Yes, the banking failure is happening in the US, and I looked at the latest quarter of TCS results. The BFSI sector accounted for 38% of the total profits. 38% share in the total segment profit from BFSI could pose a challenge to the new leader.
Experts believe that with veteran Krithivasan on the wheels, there will be no significant shift in business policy. TCS has also had one of the most stable management teams in the industry and expects to witness a smooth transition in the leadership role. The government is set to make a crucial change through the Finance Bill 2023 with regard to the provisions of angel tax. The tax will now be applicable even when shares are issued to non-resident investors. Experts believe this may not be very conducive to India's image as a destination of foreign investment. Here's our report.
Under the Finance Act of 2012, the Government of India introduced a tax to be levied on capital raised by unlisted companies. Since this primarily impacted investments made by angel investors, it came to be known as angel tax. The tax became applicable on April 1, 2013 and is levied on the amount received above the fair market value as income in the hands of a company. Resident investors have always been within the purview of the angel tax. Nearly a decade later, the government in the Finance Bill 2023 proposed to omit the condition of residency under Section 56(2)(7)(b) of the Income Tax Act, making it applicable even when shares are issued to non-resident investors. This was done to curb the circulation of illicit money as share premiums and not to tax legitimate investments.
So if the foreign company makes an investment at a premium more than the fair market value, then the differential between the fair market value and the price at which the foreign company has come in is taxed in the hands of the Indian entity. So if this angel tax is introduced, then technically you can say, suppose if they are making the investment of $100 into the Indian entity, and Indian entity has to pay tax upon the delta, that means the share premium, and assumingly suppose the competition of income comes out to be $25, and they have to pay 25% tax rate on this $25. So effectively, the amount of foreign investment in India gets reduced by $12.5.
This move has spooked startups and venture capitalists alike. They have approached the government seeking exemption for certain classes of investors and also sought some changes in the valuation methodology. The government has pointed out that startups which are registered with the Department of Promotion of Industry and Internal Trade, or DPIIT, are excluded from the purview of angel tax provisions. However, there are many startups or companies that are not registered with the DPIIT. They will come under the purview of angel tax. More importantly, the new regulations spell trouble for younger companies that are yet to register and might be looking for an investment fillip from foreign shores. Hence, this provision has the potential to significantly impact capital flows to startups and foreign direct investments, or FDI, in general. Does this mean then that angel tax is making India less attractive for foreign investment?
Yes, it makes India less attractive by making the regulation more complex and introducing the startups as well as possibly their investors to tax proceeding and things like that. But investment chases returns. And returns are dependent on the growth opportunities that are available for that capital around the globe. And I think if the assumption is that India is really an island compared to what's happening in the rest of the world, and India is where the numbers are, the demographics is, the investable opportunities are, they will possibly factor in the impact of that change and invest nevertheless. It does reinforce India's image as not an easy place to do business.
Now, with this new provision, if the foreign investor makes the investment at a price more than the fair market value, then it is getting taxed in the hands of the Indian entity. Now, exchange control also contains similar kind of a provision where Indian entity cannot receive less than the fair market value, cannot receive any investment less than the fair market value because it's an Indian entity. Indian entity has to benefit from the foreign investment. Similarly, Companies Act also impose an obligation that Indian entity cannot issue the securities less than the fair market value. So if you see the total assimilation of the tax law, exchange control, and the Companies Act, I can't figure out a way how this particular angel tax can be implemented without adversely affecting the foreign investor.
There's a likelihood that the government will exempt foreign portfolio investors or FPIs and foreign venture capital investors or FVCIs registered with the Securities and Exchange Board of India or the Reserve Bank of India from the tax. However, these two categories of investors have minuscule exposure to startups. While FPIs invest in listed companies, FVCIs put their money only in large infrastructure firms. Experts also stress that this further reduces the ease of doing business for both startups and investors.
Sure, because I think the SEBI-registered FPIs were always, anyway, it was the route for listed investments and various other investments. And therefore, it will really carve out a set of investors from or rather startups who would be receiving investments from SEBI-registered FPIs. But registration as an FPI is also not an easy process. But if somebody was, I think, only willing to do, let's say, unlisted space, they would therefore have to basically undertake the formalities for registering themselves as an FPI and then become subject to the ongoing compliance obligation. Again, if you are wanting to promote ease of doing business, is that a way of achieving that?
Therefore, experts believe that the general anti-avoidance rule provisions should be sufficient to take care of the government's concern or unaccounted money dressing up as investment. While curbing the circulation of illicit money is crucial, they suggest the government needs to pick and choose its battles when it comes to making India a more attractive foreign investment destination.
Markets have been on a roller coaster ride last week amid developments with regard to select US banks and Credit Suisse in Europe. Puneet Wadhwa caught up with Jim Rogers, chairman of Rogers Holdings, for his views on the developments and his investing strategies in this backdrop. Here's the chat.
Good morning and welcome to the show. I am Puneet Wadhwa and we have Jim Rogers, Chairman Rogers Holdings, with us on the show today. Good morning, Jim. How are you?
Good morning. I'm delighted, Puneet. I'm a fan. Very good. Thank you.
Let me start by asking you, the problems have again cropped up in US's backyard. High inflation last year, then the developments with Silvergate, Silicon Valley Bank and Signature Bank. In Europe, we had Credit Suisse too, in trouble recently. What's your development of these? What's your interpretation of these developments across the banking universe? And do you think the problems have been caged?
If you're asking about the problems in the U.S., yes, and we're going to have more. The debt in the U.S. at the government level and at the private level has risen to the highest in world history. So, of course, we're going to have more problems. We had a big problem in 2008 because of too much debt. Oh, Puneet, since 2009. The debt has skyrocketed, not just in the U.S., but everywhere. The U.S. is the leader. So the next time we have a problem, it's going to be horrible.
What about the banking-related issues, Jim? Bank, Silvergate, Silicon Valley Bank, Signature Bank.
Well, it's happened throughout history all over the world. When there's a long period of prosperity, banks get excited and get confident, and they think they're smart. And they start making loans that they wouldn't make otherwise. That's what's happening in the U.S. Silicon Valley Bank was very, very excited. They thought they were smart people in Silicon Valley. think that they're very, very smart, and many of them are, but they get carried away. They lower their standards. They think everything is okay. And that, Puneet, that has always led to problems all over the world throughout history. And it's happening again. And don't worry, before this is over, we're going to have some horrible economic problems everywhere.
Okay. So comparisons have been drawn of these developments to the Lehman Brothers collapse and the global financial crisis. What's your view here? Are we being too pessimistic?
Well, the U.S. is the largest economy in the world, and certainly the largest financial market in the world. So if we start having problems in the U.S., they will snowball everywhere, whether we like it or not. Silicon Valley went bankrupt, that led to another bank in the U.S. having trouble. Well, the next thing you know, Credit Suisse in Switzerland, a very large Swiss bank, is having problems. So all of these things snowball. What happens in one country has an effect in others, maybe not directly, not the same week, but we're all interconnected these days, especially financially, and that's going to lead more and more problems. You should be worried.
So how do you see the US Federal Reserve tackle the inflation ghost now? Do you expect the US Central Bank to go slow on rates, or probably take a U-turn and cut rates later this year?
Well, what should be done and what they will do are two different things. The U.S. Central Bank, like most central banks, they're not very smart people. That's why they work for the government. India had a very, very good central banker a few years ago. He's now a professor somewhere, but there are very few good central banks in the world, and there have been very few good central bankers in the world. The American Central Bank, they're all very, very worried. They are starting to think that they have solved the problems of inflation because some prices, oil is down, grains are down, which always happens in any market. So they think they have solved the problems. Maybe they will raise interest rates one more time, a small amount, but for the most part, they think they have solved the problem and that they don't want to cause more economic problems. And so we will see a slowdown in interest rate increases in the US for a while.
Okay. So do you expect the markets to actually correct in 2023?
Well, they already have been correcting to some extent in 2023. Yes, markets always have ups and downs. There's nothing new about that. Yes, before this is over, we will have a serious correction later in 2023. But at some point, the U.S., well, as I said, the central bank is going to stop raising interest rates. Everybody will think things are okay. We'll have a big rally. That will probably be the last big rally for a long time. And it will happen because everybody will think everything is okay now. It's not okay because inflation will come back in a big way, which means that interest rates will go very high, which means that the world economy will have a major, major problem next year or the year after, or later this year.
Okay. What are your views on the commodity segment, crude oil, gold, silver, and of course, agri?
Well, agriculture has been depressed for many years. So agriculture is still a place with lots of opportunities. I am looking at agriculture for opportunities. It's a great place, but there are many parts of the Indian economy which could be and will be very successful again in the future. I wish your government would be less interventionist. I wish your government would stay out of the way more. I wish that about all governments. I certainly wish that about the U.S. in a big way. India has been at times in history one of the world's great agricultural nations. You will be again if the government will get out of the way.
What are your views on crude oil prices, Jim? They slipped below $80 a barrel. Do you think that they will stay there, or is it a temporary blip?
I know that they will not stay there. They will go up and they will go down. I am looking to buy more energy, not today, but eventually, because energy prices have been coming down. And the world's known reserves of oil and natural gas continue to decline. fracking came along and helped us for a while, but fracking cannot save us for a long time. So there will be opportunities again in energy.
What about gold and silver?
I have a little silver right here. I have some gold too. I have been buying gold and silver for decades, and I have never sold any. I'm not buying now, but I am waiting to buy some more gold and silver. When the next crisis comes, the price in gold and silver are going to go very, very high because the crisis is going to be so bad. And you're Indian. You know better than most, and I've learned a lot from India. You know more about silver, you know more about gold than anybody in the world.
Thank you. Thank you, Jim, for your time today. We hope to see you soon.
Very good. I'd love to see you in India, and we'll all go and buy some gold and silver together.
Like the global banking sector, the Indian stock markets have remained subdued, with the market cap to GDP ratio falling to a 3-year low. India's market cap to GDP ratio fell below 100% for the first time in 3 years, as correction in stock prices over the last few months eroded the aggregate MCAP of all the BSE listed companies. However, despite the correction, India remains richly valued. In our next segment, we will decode what an MCAP to GDP ratio is and how investors should read it. Benchmark indices have declined over 7% over the past 3 months, eroding the combined MCAP of all the BSE listed companies by over 30 trillion rupees. And now, this consolidation could lead to India seeing its market capitalization to GDP ratio ending below 100 for the first time in 3 years. But is a reading below 100 a good sign? And what exactly is MCAP to GDP ratio? Simply put, a market cap to GDP ratio is a measure of the total value of all publicly traded stocks in a country divided by that country's gross domestic product or GDP. The number is multiplied by 100 to arrive at a value which is used to judge whether a country's stock market is overvalued or undervalued. The MCAP to GDP ratio is also known as the Buffett indicator. This is because celebrated US-based investor Warren Buffett believes the ratio is probably the best single measure of where valuations stand at any given moment. A reading greater than 1x or 100% is considered to be a sign of being highly valued, while a reading below 0.5x or 50% is considered to be cheap. Also, the market may be fairly valued if the ratio falls between 75% and 90%, and modestly overvalued if it falls within the range of 90% to 115%. At present, India's market cap to GDP ratio is 94%. India's MCAP to GDP ratio on an average has been around 80% over the past decade. The ratio was more than 100% in FY8, FY21 and FY22. That said, are there any shortcomings of this ratio? One of the few concerns of the ratio is that it doesn't take into account growth prospects of a country. Moreover, the ratio is impacted if there is a large increase in the percentage of companies that are going public. That's because the ratio would go up even though nothing has changed from a valuation perspective. Overall, the Buffett indicator is like a price to sales ratio for an economy. Under the indicator, investors assess the value of all stocks on an aggregate level against the value of the country's total output. However, as the ratio has been trending higher over a long period, many investors are beginning to question what a reasonable average ratio should be.
I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker
to every Indian.
The recent 10-year high MCAP to GDP ratio was 111.5%, while the recent 10-year low figure was around 53%. Well, that's all we have for you today. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.